For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about inflation, rates, and risk, why retirement just got harder. Also, how do you know where you stand in retirement, the 7 investment behaviors that hurt retirees the most and how to fix them, and then finally, what the first meeting with Floyd Financial Group looks like and why you shouldn't be nervous. My name's Jeff Shade. As always, I am just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Hey, Randy, how you doing today?
Doing very well, Jeff. How about you?
I am doing fantastic. And Jake, how is this Saturday treating you, my friend?
I'm doing great, Jeff. Thanks for asking.
Always glad to hear that. Hope our listeners having a great weekend. As always, we appreciate you carving out just a little bit of time for us here on Show Me the Money. Randy, a lot of folks here in the Ozarks feel like the ground is shifting under them. Inflation is still high and it's rising. Interest rates won't come down and the market feels strong but also shaky. So let's start here. Everyone thought inflation was cooling off, but now we're hearing that it could go higher once again. What do you think is really going on here with inflation?
Yeah, Jeff, that's a great question, and it's something that's on everybody's mind. And I also think that we have to be really careful about all the stuff we read and hear on social media and even in the news, right? Everybody has an opinion. Like my grandma Maggie used to say, everybody's got a nose and they're all different, right? So everybody's thinking a little different about it. I did see earlier this week that according to all of the people that are out there tracking this stuff that are supposed to know what's happening, about 2.8 is the annualized inflation right now. Now, of late, with the gasoline prices being high and the conflict in Iran and oil prices and all that, it seemed like it's a lot more unstable, and that certainly does affect inflation short term. I saw diesel was $4.99 a gallon right here in middle America, which is the highest I think it's ever been.
Yeah.
I think unleaded was $3.99, but I was doing the math on that and doing some reading on it, and that's probably, they said, about $70 a month extra for the average person. So while it is substantial, it's not just the end of the world. It's higher than we want to pay, certainly, but it's about $70 a month for the actual average family out there. But with this tension in Iran, until we can kind of get that under control, it's going to be affecting everything here long term. But I do think we will get some mild resolution there. And I'll tell you even a little bit more about what I think there. I think that if Iran isn't careful, what they're going to do is they are going to cut their nose off to spite their face, because we will figure out a way, and when I say we, the rest of the world, to go around them.
Absolutely. Necessity is the mother of invention. And you were talking about gas prices. I saw a picture in Southern California, I guess in the city there, but diesel was $8.99.9 per gallon. So that really can make a big difference when you're using a lot of diesel. Can you imagine those trucks that are out there on the freeway and they're in service 24 hours a day, 7 days a week?
Oh, yeah.
But inflation, as you said, it depends on where you ask or who you ask, but we're looking at right about 3%, but it seems to be rising a little bit. People keep waiting for rate cuts. It doesn't look like that's going to happen anytime soon, is it?
Yeah, we got Kevin Warsh, and again, it's going to be interesting to see what Kevin does when he comes in. He's a pretty smart guy. There's been some people that had issue with the fact that he and his wife are worth a lot of money. But let me just say this. If you're going to run the greatest economy in the world and keep your finger on the pulse of it and figure out how to manage monetary policy, would you want somebody that has money or somebody that's broke?
Well,
right?
yeah.
I mean, your job is to manage money. We might hire somebody that has some money, probably.
It's like if you want to lose weight, would you ask somebody fat how to lose weight? No, you wouldn't do that. If you want to win with money, you ask somebody who's got some money. I guess it depends upon where they got it. I don't know. Did they inherit it? Did they make it? Or do you know?
I think there was some inheritance there, maybe on the wife's side, but I think Kevin he's been around a long time. He was formerly a Fed Bank president in the past. So, I mean, he's got a lot of experience, and I think he will do fine. Him along with Besant together up there, I think they're going to do some amazing things. But the inflation thing, while it is a little bit sticky and it's a little higher than we'd want it to be, it's certainly better than it was there for a very long time. And one of the things that I have said on here before, and I think that it's still true, I think interest rates coming down is not causation for more inflation, but there's a lot of people that tend to think that is true. And I just don't think it is. I think what it can do, small companies that are growing and trying to grow and expand, many times need to borrow money. And generally, businesses that borrow money, they buy it at the prime rate plus a margin, right?
Right.
So prime rate is what the very, very best corporate customers get from their banking, whoever they're partnered with to do their banking. So if interest rates come down, that allows small companies to grow and expand and create what? More competition for the large companies and for entrepreneurs to go out and actually create something that can help drive prices down, because more production, and again, I come back to this all the time, productivity is what matters. If I have plenty of product, it drives prices down. If supply seems short, prices get high. And if there's nobody out there watching the gate, and the gate gets open, all the animals leave.
Yeah.
So all the prices stay the same, right? So I just think that there's a lot of room for improvement here. I think we're just on the cusp of seeing inflation come back down. And I'm really looking forward to seeing the economy really start to take off, and I believe it's going to in the next 2 or 3 quarters.
And for our point about interest rates, certainly it's going to affect things like credit cards and HELOCs. Mortgages, though, I mean, people were expecting mortgages to drop down into the 5 range this year. That's just not going to happen, is it?
Yeah, it got down there just for a little bit, 5.9 something it was for a week or so. But there's been a little bit more demand, so I think it's back up in the 6 range now. You know, if Kevin comes in, I mean, right now the Fed funds rate is 3.75 to 4, I think. So we're like 3.87 or whatever that number is in the middle there on average. If he comes in and takes it down, even this year, another 50, 75 basis points, we could be looking at some mid-5s for mortgage rates. And that would certainly create a lot of refi, because there's a lot of 7% money out there and 1.5% savings. That makes sense for people. Plus, I think it would also enable people to go ahead and build some new homes and be able to afford it a little easier.
Now, with almost everything, Randy, there's a flip side, too. If you're a saver, are we seeing some better interest rates in terms of CDs and safe money, money markets, things like that?
Yeah, of course, we have since March of 22, when Jerome Powell, our Fed chairman, started raising rates, and over about 14 months took it from basically where the banks could borrow money for nothing. That's why we had 3% 30-year mortgages. Took it to 5.25%, which put us to over 7 in mortgage rates. As that's come off, though, we're seeing that banks are trying to get ahead of that, because ultimately banks have 2 ways to get money to loan, right? And that is to go to the Federal Reserve or to get you and I as depositors on CDs and things like that to bring them money to loan out. So what the banks are doing now is they're starting to cut back what they're paying on CDs. And we've seen it go from where there was 5.25% to 4.75 to 4. And now I kind of have my finger on the pulse of this as I have clients come in for reviews over and over. I'm asking them, what are you seeing at the banks? Because most of them have some CDs or some money markets or savings accounts out there. And the latest rates now are coming in at 3.79 to 3.9, which tells me what? That the banks think that it's not going to go up and it's probably headed down, and they don't want to get caught holding the bag, paying too much for the money they need to loan so that they become uncompetitive in the marketplace.
Talking with Randy and Jake Floyd, Floyd Financial Group, we're talking about the market and the economy and how it affects you as a retiree or a near retiree. Our phone number, 417-889-7233. If you'd like to come and sit down and have a brief casual conversation with Randy or Jake here to find out where you are on your journey towards a confident retirement. It's not going to cost you a dime, and there is no judgment. We'll meet you where you are. Once again, 417-889-7233. Jake, the market looks strong, but we're hearing it's kind of a narrow rally. What does that mean?
So what it means is the rally is not broad-based, meaning there's a lot of stocks that are not at all-time highs, while there are some stocks that are soaring past their all-time highs. A lot of people, when they look at the market and they look at what to buy, they simply look at what's performed the best. So I get questions about SanDisk and Micron that are up hundreds, if not thousands of percents over the last year or so, just because of skyrocketing memory prices. But when we're talking about the broad base situation, there's companies like Boeing, right, that's still 50% off its all-time high. And Boeing's a big company. There's a lot of these companies that are not at all-time highs. Now, there are quite a few at all-time highs too, but not as many as there normally would be in this environment. And so that has some people having some pause saying, hey, and I don't know what the latest number is. I would say the number is probably like in the 60% range, meaning 60% of companies are at all-time highs. A lot of times when you're in this situation, you have a healthy bull market, you want to see 80 to 90% at all-time highs. I think that's more a sign of the times than it is an indicator of the health of the stock market. I think it's really more that everybody's jockeying for position for AI and who's going to win, who's going to lose, who's going to make it happen, who's going to benefit from it happening. And I think people are just trying to figure out where the best place to be is, and they know that Boeing is maybe not it, right? I keep picking on Boeing, but for example, is not the clear winner of AI really at this point. So those companies are being left behind. McDonald's, now I would argue that actually that McDonald's probably has some benefit from AI, but companies like that are not at the forefront of AI are the ones that are maybe not at all-time highs today.
Jake, as we said, the market is still flying high right now. We know that we want to buy low, sell high because of where the market is right now. Should we avoid buying into the market?
I don't know if avoiding buying into the market is the way I would put it. I would say that if you have a bunch of new money you're looking to throw in, this may or may not be the best time. Simply because if you have not been the beneficiary of the last 80 to 100% rally since the end of 22, it's hard to want to jump in here, and then the risk versus reward profile of this market at this exact moment is a little bit less attractive than it was, say, a year ago. Now, that doesn't mean the market won't keep going up. In fact, the more negativity there is, the more likely it is to keep going up. You know, if you've been sitting in CDs for the last 20 years, I don't know that today is the day to start throwing money in here. That being said, if you're funding a 401k, if you're funding retirement accounts, I would not give it any thought at all, and I would continue to just keep doing what you're doing. Every raise you get, take another %, put it in your 401k. But if you're a saver and you're retired and you have limited funds, I think there's maybe a better day coming to throw money in than today.
I want to throw this out too. If you're really near retirement, you need to have somebody help guide you through this, because
you need
there's
a plan.
ways to tie to the market,
Right,
and still have some risk protection, because you're going to need it potentially. Now, we don't want to put ourselves in a situation to where we don't have enough risk so that markets go, when they go up, we don't benefit from that. But we don't want to throw out the, as they say, the baby with the bathwater.
right.
I used to wonder where they got that saying, but I guess what it amounted to is all the adults bathe first, then you bathe the baby last, and I guess the water was kind of milky, so it would be easy to throw the baby out.
With the
That's a
bathwater.
scary thought.
All right, Randy and Jake, bottom line, what are the biggest risks that people need to be thinking about right now?
Yeah, so I would say, depending on where you are in life, if you're young, so let's quantify young.
Yeah, what is young today?
So if you're 50 and under and you're 10 years or more from retirement, maybe even 15, you still need to be investing in the broad-based market and not worry too much about it. Take advantage of what's called dollar cost averaging. When markets are high, you pay a little more. When markets are low, you pay a little less, and it all averages out in the end. But if you're within 10 years of retirement, especially if you're within 5 years of retirement, you really need to be thinking about, where am I? How does my retirement look? And the only way you're going to know that is to sit down with somebody and, hey, let's explore it. Let's look at what Social Security may be. Let's look at what you've got saved. Let's look at what potential income we have there. Does that support the lifestyle that you're looking for in retirement and all the things you're trying to accomplish? So it's a conversation that goes much deeper than just how should I invest? Because all the things that you want to do generally take money. You know, we got to fund it somehow, right?
Right.
So we need to have a little bit more of an in-depth conversation about how to position you and how to make sure that you're going to be able to weather the next storm. And make no mistake, there will be another storm, just like there always has been. Looking all the way back to 1929, and when we had the major crash there, which was really the first great big one that everybody has recorded, and all the things that have happened since then, the dot-com bubble, and of course the financial crisis in 7, 8, and 9, and then COVID, and all the things that come along. There will be more crises. And so what we have to do is make sure that when we build a financial plan for you, that we build it with resilience and the ability to rebound when things get good. And that's something that you just can't set it and forget it. You got to have a plan to start with, and you got to have a plan that you can tweak along the way as we monitor what's happening day to day.
We've been talking about inflation rates and risk and why retirement just got harder with Randy and Jake Floyd, Floyd Financial Group. You know, inflation's quietly cutting your retirement paycheck. Interest rates, they're not coming down. And if you're pulling money from the wrong places, you could be paying more in taxes than you need to. Most people do not have a retirement plan. They have a pile of accounts and money, and they have a lot of hope. Well, call us here at Floyd Financial Group today and sit down with Randy or Jake here and get your Floyd Financial Group retirement review at no cost and no obligation. Our number, 417-889-7233. It's 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Okay, Randy and Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about how do you know where you stand for retirement when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about how do you really know where you stand for retirement.
So how do you really know if you're on track for retirement, Randy? Not what your neighbor says, not what some other calculator says, but you personally, because most people either think they're doing better than they are or worse. So Randy, let's start simple. Why is it so hard for people to figure out where they stand?
Well, I'll tell you, one of the big things that we see through here, Jeff, is there are some people that can absolutely live on Social Security. And then there are others that can't live on Social Security and $20,000 a month.
Yeah. I saw a thing on, I guess it was on YouTube, but it was a 60 Minutes, or maybe it was a CBS Sunday Morning thing, and it was about people living on Social Security. And the one woman said that her Social Security makes up about 30% of what she actually needs. And she was in her 70s and she was still working. But she wasn't in the last bastion of sanity either. I believe she was in an expensive northeastern part of the country. But you're saying that here in the last bastion of sanity, that people actually can live on Social Security.
Oh, yeah, they can. And we see it happen. Now, it's not what I think most people would want, but I guess the big thing about why is it so hard to figure out, it's because some people need a lot more in retirement than others. Some people are happy just to be able to stop working and enjoy family and grandkids and stay close to home and live what I would say is a comfortable lifestyle. Still, they're not starving to death and they have clothes on their back and everything is fine that way. And then there are others that just have a different idea of retirement, and there's nothing wrong with either one of these. And that is they want to travel and see the world and do all the things they've dreamed of doing while they worked. So why is it so hard for us just to go and say, well, hey, man, you're good for retirement. You know, everything's good, right? Well, everybody's demand on retirement is different. So what we have to do is sit down and really have a conversation about, okay, here's the income you currently have, and here's what you're doing now. And by the way, remember, you're working at least 40 hours a week right now. So once you have that 40 hours a week of time freed up, how much income is it going to take? And what are your basic expenses? We talk about budgets here, and it's not that I'm trying to put people on a budget as much as I want them to understand what they spend just for basics. And then how much do you want for fun money? And then also we got to talk about taxes and the fact that things are going to be costing more in the future. That's the things we have to talk about.
Randy, is that the number one question that you get here at Floyd Financial Group when people first come in, they sit down, am I going to be okay?
Yeah, we hear that quite a bit. We also hear, so how much income can I pull off this?
Yeah.
It's the same thing, right?
We probably want to figure out if we're going to be okay first, and maybe that's the second question.
Right. Or maybe that's the one that says, ooh, so we're not okay. No.
Well, that does happen.
Most times, though, I will tell you that people around here are, they're pretty solid. They understand what a dollar is, especially if you've worked for 30, 40, 50 years. You understand where money comes from, and they've got an idea of where they stand. Sometimes people that have done really well in life, they don't really have a budget, don't know what they spend, and I understand that. I mean, as you get your house paid off, and you paid off your cars, and you paid off all the kids' college, and all that sort of thing, and you're maybe making more money than you've ever made in your life, you haven't had a budget for a while. But now all of a sudden, it's time to draw a paycheck from what you've saved. Now it's a different story. We really need to have those conversations to make sure that they're going to be where they need to be. The 4% rule has been out there for a very long time, and the 4% rule basically says, hey, whatever you've saved, 4% of that is a good annual withdrawal place to start. So let's say that you've got $1 million saved, 4% is $40,000 a year. If you've got $2 million, that's $80,000 a year that you can have off that, and probably maintain and not spend your balance down. You've got a good plan in place and you're watching what's going on. So the 4% rule does adjust a little bit for inflation, but again, depending on what inflation's doing, it may not keep up completely. And then, of course, you got all the other things that come along. We get sick. Unfortunately, we have people die early. We have market downturns. We have high oil prices.
Right.
All the things. We have wars and rumors of war. All those things affect people's retirement. So when you develop the plan, I don't say we sit around and worry about those things, but we have to consider all the things that might come along and how that might derail us.
And Randy, we hear this a lot. It's this 25 times rule. Save 25 times your annual expenses. Let's say that your expenses are $60,000 a year. They're $5,000 a month. You'd need $1.5 million to get along in retirement to be okay. But I think most people here in the last bastion do not have $1.5 million, and they're still okay. So what is the benchmark that we use to determine whether or not we're going to be okay for retirement?
So I won't say that there's an actual benchmark out there. I remember years back, you may remember this, when ING was an investment company before it became Voya, V-O-Y-A now, right?
Right.
They used to have these little squirrels and they'd say, what's your number? And they'd carry this number around, 3.5 million, 4 million, 2.5 million. They pretty promptly quit doing that because, like you said, the vast majority of Americans didn't have anything close to that. In fact, today, I think the average 65-year-old, and this is going to make some of the people here in the last bastion of sanity feel pretty good, has about $220,000 in a 401k. Now, around here, we see a little bit more than that. We have a pretty good amount of people that have worked pretty good jobs here for a long period of time. But most people do not have $1.5 million. And again, we got to remember, we have Social Security. There's a few people around here that still have pensions, maybe 15, 20%. And then whatever we saved, that's what they're going to have to live on. And so the 25X rule, it sounds good and it would make sense. I will tell you this, though. If I'm looking at $1.5 million in a retirement account, I mean, we should easily be able to withdraw $70,000, maybe even $75,000 a year off that and not spend the balance down, even though we may have some choppy up and down markets. Now, you got to have a plan that's been designed right, but you should be able to do more than that $60,000 a year. So there's no magic number. Everybody's situation is different, and that's why we tell people, hey, come sit down with us. Let's talk about it. Let's figure out where you are. And if you aren't where you want to be, we'll help you figure out how to finish the plan and get you where you want to be.
So it sounds like that there is no real number that people need for retirement. It just depends upon your individual situation. So I would say that question, am I going to be okay for retirement, is really not a valid question, because what you're saying, if I'm hearing you correctly, Randy, is that almost for most people, you can make it work unless there is some sort of dire situation. Is that about right?
That is exactly right. I mean, most people are living right where they are, right? And they tend to save money. And I mean, I'm just telling you, it generally works out for most people. Now, do they need guidance? Do they need a plan? Absolutely they do, because it's the first time they've retired. We've helped thousands of people retire at this point. So it's something we do on a daily basis. It's something most people do one time. And so there's a lot of moving parts and a lot of things to think about and a lot of ways to structure your investments to give you growth and protection, the liquidity that you need, all the things to help you live out a good, fruitful retirement.
So, Randy, someone comes into you, and I think the most common situation is that they do have a 401k. They want to turn that into a paycheck, and maybe they have been good savers. They've got $250,000 in a 401k, and everything looks pretty good. Then they get into retirement, and they run into trouble. What are the biggest mistakes that people make when trying to make this money last for the rest of their lifetime?
Yeah, I think sometimes when you first retire and you have all this extra time on your hands, sometimes it takes money to fill that time, right?
Oh, yeah.
In fact, I would tell you that most of the time it takes money to fill that time. The other thing to think about is, they think, well, I got plenty of money today and it seems like it's going fine. And especially here of late with the markets going up as they have, people have seen their account balances grow pretty strongly, even though they've been withdrawing money, right? But sometimes they don't factor in enough for inflation. They don't factor in enough for the cost of healthcare going up. If you're still working and you're thinking about retirement and you're getting close, are you funding retirement to the max? Are you taking advantage of your employer's plan to make sure you get every dollar from them that you can on their match? We want to make sure that you're getting that done. The other thing is, too, I would say that you need to be careful about these calculators that you see on your 401k website, because a lot of those out there now will say, hey, based on your portfolio and where you are, this is how much retirement income you're going to have. I got to tell you, we had those.
Yeah.
They just make no sense whatsoever. I would say be careful about using those. They'll give you a false sense of either insecurity or security, depending on which one you're looking at.
Randy, we talked about the 4% withdrawal rate. That is the amount of money that hopefully you can withdraw and still be okay. But is it a 4% withdrawal rate all across the board of retirement? Because we talked about the go-go years, the slow-go years, and then the no-go years. In the beginning, you want to go, but in the slow-go years, you're slowing down. In the no-go years, the only place you're going is to the doctor. So would you front load this withdrawal rate instead of 4%? Would you say, well, I'm going to take 6-7% here and maybe back it off to 3% later on in your life?
Well, that's an interesting question you ask. So companies today, there are companies that will, annuity contracts that will give us guaranteed income. And a lot of times, that's what people are looking for. It goes back to the old question, would I rather have $1 million or $50,000 a year guaranteed for life? Well, we know that, 5% on $1 million, if you get a 5% return, is $50,000. Whenever you take a pension plan and convert a lump sum of money to a monthly payment or an annual payment, you give up that balance. So the 5% investment rate is not hard to get back. But here's the thing. Some people want that guarantee. They want to know that they know that they're going to get that paycheck. But to your point exactly, the go-go years where I may spend more money, companies are actually starting to address that now inside annuity contracts actuarially. And what they're doing is they're taking the entire group of people that are retiring with them and using actuarial tables to figure this out. And so some are now allowing people to draw out 5, 6, 7, even 8% of their retirement funds early on for maybe the first 5 to 10 years. And then they scale it back. I even have one company that guaranteed 7% withdrawal here recently, and only if you spend your account balance to zero does your income go down, and then it goes to 3% for the rest of your life. So there's some interesting plays on exactly what you're talking about as to how to get more money now while I'm really able to enjoy it and I can travel and do the things I want to do, knowing that when I'm 85, I may not be doing triathlons and traveling the world.
All right, Randy, it all comes to this. Someone listening right now realizes that they might be behind in their savings. What can they actually do about it? Is time a factor in this?
Of course, especially right now, we feel like we're in a position to where if we can get this Iranian thing handled a little bit over here, get the oil prices settled and kind of get that Strait of Hormuz figured out over there, the market really wants to run. That's got people a little off balance. We think the market has some really strong possibility of growth in the future. So if you're not investing, you should be. Number two, if you are investing right now, but you're not maxing out what you're getting from your employer in your 401k, you should do that. If you're making a lot of income right now and you're in a higher tax bracket, let's make sure that we are max funding our 401ks and IRAs to be sure that we are getting the full benefit of that. Especially if you're within 5 or 10 years, there's still a whole lot of money that can be added into those accounts and a whole lot of growth that can come down the road. I would say the biggest thing that people need to do is come in, let's sit down, let's talk, let's see where you are. Let's figure out what you want to do in retirement, what that's going to cost. Let's see where you are, and let's figure out how to get you where you ultimately want to go.
All right, Randy and Jake, great conversation here. Most people think that they're doing okay for retirement, but I think our listeners deserve to know where they stand. And that's why Randy and Jake Floyd here in the team Floyd Financial Group are offering a no-cost, no obligation, no judgment retirement review. They'll tell you the truth, even if it's not what you want to hear, because guessing, hoping, or feeling like you're okay, well, that's not a retirement plan. Hope is never a real plan. So call 417-889-7233 today. If you want, leave your name and telephone number. Ashley will return that call and set you up with an appointment with Randy or Jake here at Floyd Financial Group to talk about whether or not you are okay in retirement. It's 417-889-7233. And of course, you can always find us online at floydfinancialgroup.com. All right, Randy and Jake, time for another break. We come back, we're going to be talking about the 7 investment behaviors that hurt retirees the most and how to fix them when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about 7 investment behaviors that hurt retirees the most and how to fix them.
And Randy, a lot of people think retirement failure comes from picking the wrong stock, but the truth is it's behavior that destroys more retirement plans than bad investments. Smart investing, I think, is 20% head knowledge and the other 80% is behavior. So, Randy, how do these small behavioral mistakes become so dangerous to retirement?
Yeah, so that's a really good question. So one is, sometimes people say, well, I need to pay this off. I need to do this first. I need to do that first before I start to save money. You need to start saving money now. So if you're a youngster listening to this, start taking some money and saving it right now. If you're an older person and you're getting closer to retirement, and I can call people older because I'm probably older than anybody listening to this, but anyway.
I don't think so.
But if you're still working and you're toward the tail end of your career, the last maybe 10 years, 5 years, 3 years, 2 years, be sure that if you're making a good income and you're paying taxes, save some of that tax money. If you can save tax money by putting it into your 401k or an IRA, you are just going to help yourself. You're going to have more money to earn for you when you do retire. Also, a couple of things to think about. Right now, this late in the game, if you're close, losses hurt a lot because you may not have time to come back and get where you want to be so that you can retire when you thought you wanted to. I would think that the biggest thing, though, that probably happens to people is if we aren't careful, we listen to the news, we hear all these people saying the sky is falling, get out, all those sorts of things. Yes, there's times that it's time to take a step back, maybe pull a little bit of cash aside to take it out of harm's way and wait for a better day. But I will tell you the biggest mistake people make is getting too nervous, too emotional, and that goes back to the behavior thing you're talking about your money. Money and emotion never go good together, whether that's buying a new car or investing your money, right?
Right.
Because when you go buy a new car and the base model is $50,000, but the really good model is $80,000.
Right.
So it's 60% more. The problem with investing sometimes is people will jump out at exactly the wrong time, not knowing it. They're thinking, well, okay, I did a good thing because the market's going to go on down. And maybe it does go on down. But then when it turns around, they can't believe that it's okay to get back in. And by the time they really believe that it's okay to get back in, most of the growth has happened and they get back in right near the top before the next market cycle. And listen, the market's going to cycle every 4.5 or 5 years, sometimes sooner than that, depending on what happens geopolitically, who's blowing up who and all those different things that happen. But really, the sequence of return risk that we talk about in here all the time is one of the things as you get closer and closer to retirement, we need to make sure we have a plan that helps us to mitigate downside and give us the lion's share of the upside so that we can stay invested, not jump out at the wrong time, and then jump back in at the wrong time and think that, well, this is just a big gamble. This doesn't even work. Trust me, investing does work, and it has for hundreds of years. I mean, all the way back to Bible times, they were still investing money, right?
Mm-hmm.
So I would say that the biggest thing is have some input from somebody that does this for a living to help you get invested, stay invested, understand where you are, and keep the conversation going.
Right, and you need sort of a financial psychologist. As I said, head knowledge is 20%, it's 80% behavior. You can change the behavior. It may not be easy, but you can change that. So let's talk about behavior number 1. People like to think that they're going to be safe if they've held a lot of cash. Why can that be dangerous?
Yeah, so being too conservative and missing out on the gains. Let's think about this. What if you had pulled money out during COVID and you were trying to find a good time to go back in and you still haven't done it? Well, since COVID, the market, that was 3,373 points, the S&P 500 was. Today, it's 7,200. Ouch. You've lost a lifetime of income. I mean, just in that time frame. So sometimes, while it feels safe, being too conservative can really be a problem. Now, I won't say that there's not a place for cash. There is. Everybody needs at least 3 to 6 months of liquid money that they can easily access, it's not really subject to the ups and downs so that we can handle the emergencies and things that come along. But boy, not being invested, especially, like I said, during this last actually, if you look at it all the way back, we were just looking at this a couple of days ago, since 1980, the S&P 500 was 112 points in 1982, and of course today it's 7,200, so we're talking about 70 times growth. I mean, is the market the only place to put money? No. It's a great place to grow money. It can be a hard place to protect money. That's why you need guidance and somebody to help you put a little bit of a floor under your money and help you get the lion's share of the gains and help you mitigate the downside.
So the number one behavioral mistake is maybe holding too much cash, trying to be a little too conservative. Let's talk about number two, trying to time the market. People say, I'll get out now and get back in later. Why does that backfire?
Well, I don't even tell you right now that there's probably a lot of hedge fund managers out there with a lot of cash on the sidelines that wish they didn't have right now,
right? Because
they've missed out on this last little bit too. Think about this, Jeff. We were talking, and Jake helped me with this. What's it been? 3 weeks since the market was 6,300, maybe 4.
I'd say 5. It's probably been 5 actual weeks,
and the market has rallied probably 15% since then. And while that, if we look back about 60 weeks. Remember, last April of 2025, the S&P 500 went down to 4,800 points. A lot of people jumped out and did not get back in, and now we're at 7,200 points. I mean, that's a lot of growth that has been missed out on. So trying to time it, saying, okay, I'm going to get out now. Now I'm going to get back in. Well, when do you do that, right? Because the emotion is, man, that thing was way down there, and now it's way up there. It's got to be going way back down soon, right? So the problem that happens is trying to figure out the timing. And I've said this on here before. We know causation. We know that high interest rates typically push markets down. Low interest rates tend to push markets up. Geopolitical pressures can turn things sideways in a heartbeat. How people feel just in general can change things. But we have to take the emotion out of investing and look at what is actually the underlying causation for what's happening now. We know causation. What we don't know is exact timing. And that's where taking the emotion out of it is a huge factor.
So behavior number 2 that we want to avoid is trying to time the market. Let's talk about number 3, which has to do with taxes. The tax man cometh, and like an ostrich, many times people just put their head in the sand, but then they end up getting eaten up. Not a good strategy. Why is that such a big deal, taxes?
Yeah, for sure. So there's so many different ways that money gets taxed. There's capital gains tax. There's IRAs that have never been taxed. That's the ordinary income tax. Your income from your paycheck is ordinary income tax. There's Roth accounts that some people have out there now that after 5 years, you get to take all that growth and everything out. Just so many ways. Social Security can be taxed at 0, 50%, or 85 cents on the dollar. You just have to see how that's going to happen. But also, if you make a good income, it could be that you're going to be subject to paying more for Medicare, this thing called IRMA. That's the income, something like in respect to how much money you make. And if you make too much money, Jeff, I mean, can you make too much money?
I'm not sure. Maybe you can.
You have to pay more for Medicare.
Yeah.
How you withdraw money, where you withdraw money from, all that determines your taxes. And I love what my tax guy always said. He said, people come in, they throw this pile of stuff at me in this box, and they say, please be kind.
Be gentle.
Yeah, be gentle.
Be gentle.
And it's a foregone conclusion then. What we need to be thinking about is now, how do we want taxes to be next year?
Right. So ignoring taxes in retirement is our behavior number 3 that we need to avoid. Let's talk about number 4 here, chasing yield. Everybody wants income in retirement, but chasing yield can be risky at times, right?
Especially, there's some people listening here that'll probably remember years back, there was a company here in town. I think it was Sinclair was the name of the company. And they were offering 14% returns, and they were doing some type of mortgage lending. Boys and girls, let me tell you something. Anytime somebody offers you a 14% return, you just better run.
Yeah, I know.
It's just not good. Do they happen? Do things happen like that? Yeah, if there was a point in time here a few years back where interest rates were higher, and as rates came down, bonds got not only the yield that they had underneath, but they also got price appreciation, because as yields go down or as interest rates go down, bonds can become worth more because they pay a higher rate from the past than they pay at current. There's lots of different ways to make money, but chasing yield is not really one of those. I mean, when people are offering you high returns, it's generally because there's 2 things. either high risk or very illiquid. Really, those are the two things. In fact, I'll tell you the one that gets me right now. If you've been watching anything over the last couple of months, all these private equity firms that all these states dump their pension funds and everything into are now having trouble, and they're illiquid, and they're going, hey, wait a minute, you didn't tell me this was illiquid. Well, now they tried to get a good return. Now they're hitting a illiquidity situation, and also their yields are dropping, or they're not making any money on those at the same time.
All right, Randy, let's talk about our last behavioral mistake here. I think the two biggest emotions are fear and greed. And when it comes to greed, people hear news and they go, wow, this is something that I've got to do. And the latest one has to do with an annuity from a major carrier that is offering a 34% bonus. 34%. What does that actually mean, and why do people fall for something like that?
Well, I have one better than that, Jeff. I saw one yesterday advertised to me as an advisor that paid 52% bonus.
Oh, my gosh. Now, people hear that and they go, wow, 52%. I'm going to invest my money, and the next day I'm going to have 52% more. That's not the case. It's not spendable money, is it?
That's exactly right. It's not spendable money. So here's the thing. There's 100 cents in every dollar, and no matter how much we want to try to make it 101 or 102, it never is. So anytime you see a bonus like that, it always has what's called a vesting period. Most of them take at least 10 years or more to vest, and early on, you might get 10% of whatever that is in the first year or so of that. The other thing I would tell you is anytime we have an investment, we're also looking for that investment to make earnings for us. If they give us all that money up front, I will promise you this. You're not going to make any money on the investment itself. They're going to have to screw that down so much because at the end of the day, they have to protect themselves, whatever company is offering this bonus, and they're going to because they have to stay in business. And they have a whole team of actuaries. That's people that have more math in their little fingernail than I have in my whole body. Mm-hmm. And they have worked these equations every way possible, and they know how to mitigate risk down to generally 0.25% per year or less for that company. So the long and the short of it is that is a fictitious thing. And if you want to talk to me about one of those bonuses like that, come see me. We'll show you exactly how the cow eats the cabbage.
I like that one too. That's another one I'm going to look up, the etymology of how the cow eats the cabbage. Talking with Randy Floyd, Floyd Financial Group, we've been talking about behavioral mistakes that people make with money. Once again, Randy's number 417-889-7233. That's also the number for Jake. If you would like your complimentary Floyd Financial Group review at no cost and no obligation, it is 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Well, Randy and Jake will take a break. When we come back, we'll wrap it up by talking about what the first meeting with Floyd Financial Group looks like and why you shouldn't be nervous when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, the question we get all the time is, so what happens and what does it really look like when I come to sit down with Randy and Jake?
And Randy, I think one of the biggest reasons that people delay getting financial advice or help is fear. They're worried that they're going to be judged, they're going to be pressured or told that they've done everything wrong. So today, I want to pull the curtain back just a bit. Randy, why are so many people nervous about that first visit?
Yeah, I think you're right. I think that we all, since we go through life and we don't really go up and down the street saying, hey, Joe, how much money you got in your 401k?
Yeah.
Hey, Bill, what do you got over there? How you doing? What's your Social Security going to be? We don't go up and down the street doing that. So it's kind of one of those taboo things that you really can't talk about, right? So when they come in and the first time and they're wondering, okay, so how is this really going to go? And are they going to judge what I've done and the money that I have and all that? And the answer is simply no. We're not going to do that. Everybody has a different situation. Our biggest thing when people come in is we want to learn, number one, what's important to them. That's what we call our discovery phase. And that just is basically sitting down, talking, maybe having a cup of coffee or a soft drink, and just really getting to know that person, what's important to them and what are they trying to accomplish.
So I think that really people fear this because some other advisors, maybe they've been to other advisors, and it's really more like a sales pitch. They lead with a product, and they don't really ask who this person is and what their hopes, dreams, and goals are for retirement. But you're saying that really we put that aside in the first meeting, at least up front, and you talk about people's hopes, dreams, and goals in retirement. Why is that so important instead of leading with a product?
So it's kind of like going to the dentist, and he doesn't know if you have a toothache or if you need braces or if you just need a cleaning, right?
Right.
So I don't want him to pull out the drill and go to work if all I need is a cleaning,
For
right?
sure.
So what we really want to learn is where people are and what they're really trying to figure out. Because at the end of the day, you don't care what I think. You want to know how what I think applies to your situation, and you want to see what I have to say. We like to think of this as an educational process, meaning we don't know what we're going to offer you or what's going to be the best setup for you until we know you, right? We got to know about you. We got to know about what your income needs are, what you're looking to do in retirement. How do you feel about the risk of the market? How do you feel about taxes? All those different things come into play. And what do you plan to do the first few years? And how does that differ maybe from when you're 80 or 85?
So that's the first step, is what we call the discovery process, and that's finding out what makes you tick. What do you want to do in retirement? What do you like, what you don't like, and what your biggest fears are in retirement? Then we move on to step number 2, and we call that analysis. Do you do that with a person sitting right in front of you? And what is the analysis?
So basically, the analysis is we just kind of want to sit down and say, okay, have you gone out to Social Security to kind of see what your Social Security may look like? Do you have a pension? If they do, we'll talk a little bit about that. And then we'll see what investments they actually have. And then we know kind of what they want to do in retirement. We kind of figured that out. We're going to see what they have. And then from there, we generally are going to go to probably a second meeting. And that's where we're going to actually talk about potentially building a plan and have some stuff put together to talk about. And it's not like it's our way or the highway. It's one of those things to where we kind of collaborate and we show you the ins and outs of why we offer what we do and why we've set things up that way. And it's a question and answer session because everybody has to have a comfort level with what we're talking about.
So that first meeting consists of the discovery process, and then we get into the analysis. As you said, it's finding out what you have and then what your hopes, your goals, your dreams, and your visions for retirement are. That is session number 1. What does that usually take, about 60 minutes or so?
Yeah, we usually allow an hour to an hour and a half. We may not need the hour and a half, but I sure hate to get to the end at 59 minutes and somebody has a very probing question and I say, well, I'm sorry.
We got to go
wait
here.
till next time. Yeah.
Yeah, and that does happen with some financial advisors. They've got them scheduled 60 minutes at a time, and they're going to rush you out the door. We don't do that at Floyd Financial Group because we're just one of you right here in the last bastion of sanity. We want to get to know you. How can we really do a retirement plan for someone if we do not know them? So let's skip on to the third part of the meeting here, and that is the planning process. Is this something that you do behind closed doors, or do you have the client right in front of you when you do this?
Great question, actually. So we generally will do some planning based on what we've learned about discovery and what they have to work with and knowing what's important to them. So when they come back, we're going to have the framework of a plan worked out and we're going to talk about those things. But again, it's very important to understand that we're going to have a question and answer session there, and we want to educate them on why we're doing what we're doing. It's something that we don't ever get in there and say, okay, are you going to do business with us or not? It's not one of those things. We talk about it and we tweak the situation to where the plan makes sense for everybody concerned.
So far you've done a discovery, you've done an analysis, and now you're doing a planning. I mean, you have invested a couple of hours in this process, and people are probably reaching for their checkbook saying, well, how much do I owe you? Do they owe you anything?
So no, what we do as a part of setting up, we're a fiduciary and we're very open about everything that we do here. Part of this process is just getting the plan developed before we implement it, which again is the next step in the process is implementation, and we help people get through that process as easily as possible. But the way it generally works is during the planning session, it's going to make sense because it's based on all the things that we've talked about, their goals, their dreams, their desires, working with their money. It's going to make sense to them. But many times what happens is it just kind of comes down to, so what's our next step? And that would be to implement the plan. So when we implement the plan, we do all the paperwork and all the behind scenes work to get everything moved and set up and start their regular income from there.
So I think a lot of people maybe like some of the people that they've worked with in the past. Maybe they've liked their advisors. They certainly know their family and so forth. Breaking up is hard to do, as the late Neil Sedaka said. How do you handle that part of it, breaking up with the old financial advisor?
Yeah. So if they have that situation, we can help them to craft a letter that says, hey, thank you for all your past service. We really appreciate all that you've done for us. But in this stage of life, we feel like we're into retirement now and we need to go to the next phase. Work with people that do this retirement planning at the final stages for a living. So if you're coming out of a 401k plan and that sort of thing, in most cases, you haven't had much hand-holding. And so it's going to be like a brand new world when you come in here and you sit down with us, and we're here to talk to you about why things are how they are and how they work that you may have never heard before. Because generally speaking, I mean, I don't know about you, Jeff. When I used to have a 401k when I worked in corporate America, I never, ever, not one time, ever, and I worked for a major company, a little food company called Kraft.
Yeah.
We never, ever, one time, not ever heard from those people.
Wow. Okay, so we've talked about discovery, we've talked about analysis, we've talked about the planning stage and implementation. You've done all of this. I would imagine now there is the follow-up. So what is involved with the follow-up, and how often should we follow up?
Yeah, so early on when people retire and they're just getting settled in and we started writing them their first monthly paycheck, we're generally going to have another review meeting about the first 90 days out. And then from there, depending on what they want, it may be another 90 days, or they may say, well, let's go 6 months, always knowing that we're here and we're a phone call away if a question comes up or something they need out of the ordinary comes up. But then generally about every 6 months, we're going to sit down and talk with people. If people want more time than that, we can do 90 days. But generally, once people get settled in, once every 6 months is plenty. And we even have some people that we've had for a very long time now that know they can just call us at any time. We meet with them formally one time per year, but during the year, they may give us a phone call and say, hey, I need an extra withdrawal for this. Hey, I'm thinking about buying a new car. Hey, we're thinking of moving to Florida. They're going to ask us some questions along the way, but we just try to meet people exactly where they are with what they need.
All right, so it's discovery, analysis, planning, implementation, and finally the follow-up. That is a lot of work. I would imagine that it's a fair question to ask you. So you've done all this work. How do you get paid? How do you answer a question like that?
Yeah. So the way that we get paid, generally speaking, is for assets under management. And we park money at Charles Schwab, which is a huge company, one of the biggest in the business, and very safe, a lot of security there, generally 1% per year. And we don't use mutual funds here. We use mainly exchange-traded funds that look similar to mutual funds, but they have a much lower cost. They trade on the open market, which makes it much more efficient, and they're more tax efficient to boot. And then we own individual stocks besides that. So you're going to find that we're very competitive. We're very open about how we charge. And I often tell people, if we're not worth 1% per year, you need to fire us anyway.
Yeah.
And you'll find out that we are.
All right. So for our listeners who would like to take that first step, once again, the number 417-889-7233, 417-889-7233. I know you've been putting this off because you're nervous. Well, you're not alone, but now you know the truth. This is not a high-pressure sales meeting. It is a conversation about your life. Once again, no cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233. We're also online at floydfinancialgroup.com. Well, Randy and Jake, we're out of time for this week. I want to thank you for your time, but most importantly, as always, I want to thank our great listeners here, the last bastion of sanity. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.